Welcome to the deep dive. Today we are tackling the Q3 2025 earnings call for Bowman Consulting. They're a really key player in that whole engineering and infrastructure space.
And our job here is to basically cut through that, that dense transcript and give you the essential takeaways. And today, honestly, it's about solving a massive paradox.
It is a complete head scratcher. You've got a company saying, hey, we hit our big internal goals, and they deliver this massive beat on adjusted earnings per share. We're talking 65% above what analysts expected.
And then the market just ruthlessly punishes them. The stock plunged over 22% right after the call, on heavy volume too.
Wow. That kind of violent reaction, it tells you that investors were looking right past that headline beat.
Oh, completely. They zeroed in on something else.
Yeah.
You just don't see a drop like that unless there's a deep fear about execution or maybe the quality of the profit itself. We need to figure out what the street actually decided to penalize here.
Okay, so let's start with that snapshot of the results, because the numbers themselves are so contradictory. On the bottom line, it looked fantastic. Adjusted diluted EPS came in at 61 cents.
Which is just remarkable. The consensus on the street was only 37 cents. So that's a 24-cent surprise, a 65% beat. Ordinarily, a stock soars on that kind of news.
Ordinarily, yeah. But this is the other side of the coin. Profit was great, but revenue. There was a small miss. Gross contract revenue was $126 million. Net service billing, $112.1 million.
And both of those are up a healthy 11% over last year. So, it's not like they're shrinking.
No, but they missed. The consensus was looking for something closer to $129 million, so it was a slight 2% miss.
And that tiny top-line miss seems to be the trigger for the whole thing, the whole catastrophe. The market right now, it just values revenue certainty over these, let's say, accounting-aided profit spikes.
So the stock closes down 22.4%, and then it kept falling the next day. It just suggests this deep skepticism about turning their backlog into actual cash.
Exactly.
Wow.
So that's the setup. Massive beat, modest miss, massive plunge. So let's talk about what management actually got right, because they did deliver on two huge promises they made a year ago.
Right. They promised GAAP profitability and better cash conversion.
And they delivered. They absolutely did, which makes the reaction even more confusing. First, they hit a new scale. They officially passed the $500 million annualized gross revenue run rate. That's a huge milestone.
And the quality metrics, you can't deny the improvements there. GAAP net income was $6.6 million. A year ago, it was just $0.8 million. That's a huge swing.
And the cash flow story is, frankly, stellar. Year-to-date operating cash flow more than doubled. It's up to $26.5 million from $12.4 million last year.
Okay, so they're converting earnings to cash at about a 50% rate now. That signals much tighter management. The market seems to have just ignored that completely in the panic.
Completely. And their future visibility looks amazing. The backlog grew 18% to a record $448 million.
And their book-to-bill is still above 1. Management even pointed out that Q4 bookings were already coming in faster than Q3. So it sounds like a timing issue, not like they're losing work.
That's the narrative, and the growth drivers seem to back it up. Look at where the growth is coming from. The power, utilities, and energy division. That was the fastest growing. It surged 38% year over year.
38%. In this environment, that's explosive. And they explicitly said this is their number one long-term engine.
Right, which aligns perfectly with this national push for grid modernization. It's a huge tailwind. And transportation was also very strong, up 20%.
That's the stable, resilient part of the business, benefiting from the IIJA, the big infrastructure act.
And management made a key point there. They said less than 25% of those federal funds have even been released yet. So they have this very long, very high quality runway revenue just sitting there waiting for them.
That's such an important piece of context. The demand is locked in for years. Okay, but we have to get back to the problem. That huge boost to GAAP net income. The $6.6 million, that seems to be where the street smelled smoke.
This is where we have to get into the weeds on the purity of those earnings. Because while $6.6 million looks great, it relied really heavily on a huge one-time tax benefit.
Okay, so they adopted new tax rules. They called it the OB3 change. What did that let them do?
Well, it basically allowed them to unlock about $52 million of what are called DTAs, or deferred tax assets. For you listening, just think of a DTA as a tax credit they had on the books, but couldn't officially recognize until now.
So it improves their balance sheet, but it's not cash they generated from, selling engineering services this quarter.
Exactly. So if you strip that out, the actual operational profit improvement looks a lot less dramatic. The market sees a big, non-recurring, non-cash adjustment like that and just immediately discounts it.
It creates a halo effect that isn't really sustainable.
Right. But to their credit, they did improve the quality of earnings in another big way. They cut way back on stock-based compensation. It dropped from over 7% of net service billing down to about 4.4%. That's a real permanent improvement.
That is real discipline. Okay, let's shift to their strategy, their long-term moats, because that's what the market seems so conflicted on. They are clearly trying to own this generation-to-grid continuum through M&A.
That is the entire strategy right now. The recent acquisitions are critical. You've got Sierra Overhead Analytics and ORCaS, which bring in these tech-enabled mapping tools.
But the big one seems to be Lazen Power Engineering. What does that one do for them?
Lazen puts them squarely in high-voltage transmission design. That is a hot market. It's high margin and, more importantly, it has recurring revenue. With the grid needing a massive overhaul nationwide, owning a platform there is it's a fantastic position to be in.
So they're spending now to lock in much higher margins down the road, and it sounds like they're still doing some internal R&D too.
They are. It's small. This big fund they have is only about $0.3 million so far this year. But it's funding things like AI-enabled asset control kits. And importantly, they are not adding the spending back to their adjusted EBITDA. They're eating the cost.
That signals they're confident those investments will pay off quickly. Okay, what about competition? On the call, they were asked about these bigger total solution firms. Did they sound worried?
Not really. They dismissed it. Management's view is that those huge firms often end up subcontracting the really complex engineering work back to specialists like them anyway.
So they see their specialization as a shield.
They do. Now, the market might challenge that, but that's their position. They believe that specialized skill will always be in demand.
And what about macro risks, like a government shutdown? They sounded pretty calm about that.
They're calm because so much of their work is with state and local governments, which are more insulated. They basically said a shutdown just causes timing delays, not cancellations. They even quantified what they need in Q4 to hit guidance. They said it's equivalent to only a few days worth of extra utilization.
Yeah.
Sounds very manageable.
Okay, so let's synthesize this. They're efficient. They have a record backlog, 38% growth in their key segment. Why on earth did the stock plunge 22%?
It comes down to three things the market fixated on. First, that revenue miss, however small. It suggests slow conversion. The market is impatient. Second, the earnings purity. That $52 million DTA release really tainted the GAAP profit number for investors.
And the third thing must be the growth quality, the perception of it anyway.
Exactly. Organic growth is a respectable 11%, but the headline number is so heavily acquisitionated right now. When you do a lot of M&A, the market automatically prices in a higher risk of integration failure until you prove otherwise. That 22% drop is the market pricing in that risk.
Even though management is painting a pretty rosy future, they reaffirmed their 2025 guidance. And more importantly, they initiated 2026 guidance.
And that 2026 guidance is the whole counter-narrative. They're guiding to revenue between $465 and $480 million. But the key is they're promising adjusted EBITDA margin expansion up to 17, maybe 17.5%.
So the market is punishing them for Q3 noise, while management is pointing to 2026 and saying, this is where the new, more profitable strategy pays off.
That is the disconnect in a nutshell. And analysts, for what it's worth, are siding with management. The consensus is still a strong buy, with an average price target around $49, $50. That's a 40% upside from where it's trading.
Which sets us up perfectly for our segment where we pitch an outrageous but plausible trade. And just a reminder, this is absolutely not financial advice.
Please proceed with extreme caution.
Yeah.
This stock just showed its teeth.
It certainly did. Okay, so we have a company down 22%, but it's sitting on a record backlog, and its most important segment is growing at 38%. This smells like a classic volatility trap.
So you're betting that the panic was a huge overreaction and that good execution will correct the price.
Exactly. The outrageous trade is a two-part strategy, and it's all based on a conviction in that 2026 margin promise. First, you capitalize on the immediate panic. You could execute an aggressive short-term call spread, betting on a quick 10% rebound off the bottom.
A quick, high-risk trade on the bounce.
Right. But the real thesis, the conviction play, is longer term. You establish a deep-in-the-money long-term call option position, something that expires in late 2026. This is a direct bet that they successfully integrate this generation-to-grid strategy. They hit that 17.5% margin target, and that huge valuation gap closes.
So you're not betting on Q4. You're betting on the 2026 story, ignoring all the current accounting noise.
Precisely. You're betting that those $50 analyst targets get realized once the M&A synergies are fully proven out in 18 months.
It's a very compelling, very aggressive thesis. The integration risk is real, but the potential reward captures that 40% upside analysts still see locked inside the business.
And that wraps our deep dive on the Bowman Consulting call. The tension is just so clear here. They delivered on their promises. They have a record backlog, a clear plan for 2026, yet the stock trades like it's on the brink of failure.
And the key question for you, the listener, is really whether the market is putting too much weight on that non-cash $52 million tax benefit and not enough weight on sustained high double-digit growth in these critical infrastructure verticals.
The disconnect is undeniable. The infrastructure space is definitely one to watch. Thanks for joining us for this deep dive.